Hello, everybody. Thank you for joining us today. We are very excited to have Wilmot back, a celebrity guest here, guru of all things financial planning and wealth management, taxes, and the like. So, Wilmot, thank you again for joining us today. We've got a great subject, and we've got the best person to talk about it. So we'll just leave a minute or so for everybody to settle in. Hopefully, you've got something to keep you and your brain engaged as we go through this. But today we're going to talk about all things trust. So what is a trust? Why do you need a trust? Do you need a trust? When should you consider a trust? How does it work? What are the legal implications, the tax implications? We're going to basically do a nice deep dive on all those concepts so you have a better understanding of the uses, when they apply, and when likely you don't need one. So really excited to be looking at that today. It's a topic that we discuss often, and it comes up. So it's really fun to have Wilmot today and Per and the rest of the team and be able to share this today. So let's just have a look here as everybody's settling in. So again, thank you for joining us. I'm Erik as part of the WWH Financial Group, and very excited to have you here today. Just say hi to Lucille, hi Ismail, hi Graham, hi Sherry, hello Aaliyah, and we've got a bunch of other participants that will be joining us today. So again, big thank you for that, and we will get started very shortly. Hello, Graham. Okay, so this is our team. I think most of you have seen us already, but if you haven't, I do want to introduce Kashvi, who's our newest intern and co-op student. So very excited to have her here and part of the team. So welcome, Kashvi, and thanks for sharing your time with us. Shout out to Leah, who's also running the marketing in the background and helps put this all together. So big thank you, Leah. Some of you might have heard him already, but he's the great Wilmot George, and we're very excited to have you here. Wealth of experience and knowledge. So Wilmot, again, big thank you for sharing and being part of this with us today. Clients always appreciate it, always have great feedback. So it's an honor to have you back and talk about trust today.
Thank you. Good to be here.
Wonderful. Okay, Leah, so I think without further ado, last notes of housekeeping. If you do have any questions, please feel free to use the chat below, and we'll look to get to that at the end of the presentation. So Wilmot's going to take us through this, but if you do have questions, put them in, and then we'll look to get through the Q&A after the fact. So without further ado, want to pass it off to Wilmot. Thank you, everybody, and enjoy today's webinar.
Thanks, Wilmot.
Thank you, everyone. I appreciate the opportunity to participate in an important topic, wealth planning using trust. We hear about trust quite often, but we don't necessarily understand what trusts are, why they're used, where they're most effective, what the different types of trusts are, and so on and so forth. So this is a great opportunity for us to discuss that. So thank you to our friends here at Assante for inviting me to talk about this. Whenever I get the chance to talk about this, it stirs me up a little bit because it gives us an opportunity to delve deep into the area of trust and talk about how it can help your families. Now, trusts aren't for everybody, but they certainly do have their place. So what we're going to do is walk through this. I think I got maybe 45, 50 minutes, something like that. We'll go through it, and time permitting at the end, we'll do a Q&A period. And if we can't answer your questions during that period, we'd be happy to work with you offline and get you the content that you need. All right, so let's step forward. Next slide, please. We're going to talk about what is a trust, right? Because, how are we going to talk about trust without describing what a trust is? So we're going to start. This is Trust 101. So we are going to start with what is a trust. Then we're going to talk about how trusts are structured. We're going to talk about why consider a trust. And then we're going to talk about some strategies, different types of trusts, and some strategies that you can use if you want to engage the trust market. And then we're going to close with a conversation on the taxation of trusts. All right, so that's where we're going with today's presentation. So next slide, please. So what is a trust? Why do we hear some folks talking about a trust? What does it look like? Do I need one? Right? Legally, a trust is a relationship in which one person, we'll call that person the settlor, gives property to another person, we'll call that person the trustee, who holds that property via a trust for the benefit of beneficiaries. In other words, if I say that I want to establish a trust, then I am the settlor who contributes property to the trust, and that property is managed by another party, can be managed by myself as well. Perhaps it's managed by me directly. Perhaps I'm a co-trustee of my own trust that I'm settling, right? So I have a settlor. I'm a settlor. I'm contributing property to a trust. That trust is going to be managed by a trustee, and the assets are being held for a beneficiary or beneficiaries. Right? Now you can have more than one trustee, you can have more than one beneficiary, but what you have is a relationship between the settlor, the trustee, and the beneficiary. Once the assets are transferred to the trust, they no longer belong to the person who transferred them. So if I'm going to transfer property to a trust, the trust now holds the property. The trust now owns the property, and it's being managed by the trustee for the benefit of the beneficiaries. Now, as mentioned, I am giving up that property to the trust, but I might also be a trustee or co-trustee of that trust. I might also be a beneficiary of that trust. Perhaps there are certain conditions associated with the trust, perhaps not. We can talk about that as we go. But once the assets are transferred to the trust, they no longer belong to the person who transferred them. Instead, they belong to the trust and are administered for the benefit of the trust beneficiaries. Okay? At its core, that's what a trust relationship looks like. Next slide, please. Now, to create a trust, you must have three certainties. Three things must exist for you to have a trust. Number one, certainty of intention. So there must be a clear intention by the settlor to create a trust, right? I must intend to put property into a separate entity, that being the trust. So that's the certainty of intention. You must have certainty of property. So there must be property that I am transitioning to the trust. And number three, we must have clearly defined beneficiaries. If we have those three things, then we have a trust. If the certainties are not clear, then there is no trust relationship. All right. Next slide, please. Okay, so how are trusts structured? Next slide. We have two types of trusts at its core. That's it. I know you may have heard of different types of trust: family trust, alter ego trust, Henson trust, joint partner trust, spousal trust. You've heard of all these different terms, but the truth is all of those terms are really just a variation of one of these two trusts. There are inter vivos trusts, and there are testamentary trusts. Inter vivos trusts are trusts that I set up while I'm living. Testamentary trusts are trusts that I set up at the time of death, typically via my will. All right. So if I want to establish a trust, a key question for me will be, do I want to set up this trust before I die? Or do I want to set up this trust at the time of death via my will? There are pros and cons associated with each of those. But really, there's only two trusts. So I can have a family trust that's an inter vivos trust, or I can have a family trust that's a testamentary trust. I can have a spousal trust that's an inter vivos trust, or I can have a spousal trust that's a testamentary trust. Really, only two types of trusts: inter vivos or testamentary. Next slide, please. Okay, how are trusts structured? Okay, so we've got inter vivos trusts. An inter vivos trust, as mentioned, is a trust established during one's lifetime. And by setting it up before we die, we're able to avoid the estate at the time of death. Because if I transfer assets to a trust now, then when I die, those assets don't belong to me. They don't flow through my estate. They're not subject to complex estate settlements. They're not subject to estate administration or probate fees, because those are things that apply to the estate. And if this money was moved into this trust, or this asset was moved into this trust before I died, they don't flow through my estate, so not subject to those complex situations. If I transfer assets to a trust before I die and my estate is probated, the assets bypass the estate because they went to the trust before I died. So it provides a certain level of confidentiality. Assets that flow through the estate, if the estate is probated, that becomes a public document. right? So you can achieve confidentiality through an inter vivos trust. But transferring assets to an inter vivos trust, depending on the type of trust we're creating, you typically have taxation on the transfer into the trust if you're transferring property as opposed to cash. Right? If you're transferring cash into a trust, cash is just cash. There's no appreciation in value before the transfer, so no capital gains tax, for example. But if I'm going to transfer my stock portfolio into the trust and the stocks have gone up in value, when I transfer the stocks into the trust, I trigger a taxable event. So we want to be mindful of that. Well, let's talk about the testamentary trust. Well, that's established at death. The assets flow through the estate at death, so they can be subject to complex estates and estate administration or probate fees. But with a testamentary trust, there's no taxation until death of the settlor because you're not transferring the assets until the time of death, right? And the other thing, too, is when you use a testamentary trust, you own the asset right up until the time of death. So you don't have to worry about separate trustees while you're living and so on and so forth. Those are conversations that happen after your death. So you have full control of the asset up until the time of death. So sometimes we see inter vivos trusts get established. Sometimes we see testamentary trusts get established. It really depends on your preference, the circumstances that are driven by your situation. Okay, next slide, please. All right. So why consider a trust? Next slide, please. There are a number of reasons why one might want to consider a trust. Chief among them is control. Trusts are not typically used to save taxes. Okay? Any tax benefit associated with a trust that used to exist years ago, the majority of the tax benefits you used to get using trusts years ago are no longer. The government has made some changes to tax legislation as they relate to trusts so that people cannot use trusts primarily to save taxes. Trusts are generally subject to tax at the top tax rate. There are some ways to plan around that, but trusts are typically not used for tax savings. Trusts are used for control. So let me give you an example of what I mean. I want to transfer assets to my kids, but my kids are not responsible enough to manage those assets. So what I want to do is move those assets to the trust and have a separate trustee who can manage those assets on my kids' behalf and pay out the assets to my kids over time. Maybe my kids are living with disabilities and cannot manage money. So maybe what I want to do is put the assets into a trust and have a separate trustee manage those assets on behalf of my children who are living with disabilities, and they can get money as needed, which might help them to preserve their social assistance benefits if they're receiving that. Control. Trusts are typically used for control, to control appropriate management, asset protection. Asset protection. Maybe I don't want to leave the assets directly to my kids because my kids aren't in stable relationships. And if I leave the assets to them directly, depending on what they do with the assets may become subject to division in the case of a relationship breakdown. I don't want to do that. I want to protect the assets. Perhaps my kids have other creditors, and I don't want to put the assets in their hands directly because their creditors might have access to those assets. So I'm going to use a trust to help guard the assets, right? Use a trust to avoid delays that might present themselves when assets are flowed through the estate at the time of death. Perhaps I want to avoid or reduce the potential for probate fees at the time of death. Perhaps I want confidentiality, so I'm going to use an inter vivos trust, for example. These are all reasons why people consider trusts. There's others as well, but those are the primary reasons. Okay, next slide, please. Okay, so now that we've talked about the types of trusts, inter vivos versus testamentary, now that we've talked about why individuals might consider trusts, let's talk about some wealth planning strategies involving trusts. Next slide, please. Right? We mentioned earlier that there are different variations of inter vivos trust, different variations of testamentary trusts. There might be family trusts that are inter vivos trusts, family trusts that are testamentary trusts. There might be spousal trusts that are inter vivos trusts, spousal trusts that are testamentary trusts. There might be a Henson trust that's an inter vivos trust, or a Henson trust that's a testamentary. So what we want to do here now is go through the different types of trusts and describe what they are and how they might be used. The term family trust, which some of you might be familiar, is actually not a legal or tax term. If you open the Income Tax Act and you look for family trust, you're not going to find it. It's not a defined term for tax purposes, right? Family trust is kind of a term that, gets attached to a trust that is used for the benefit of family members. So it's not a legal or tax term. It's used to describe a trust where beneficiaries are family members. It can be discretionary or non-discretionary. And that's an important term, discretionary or non-discretionary. What does that mean? Well, if a trust is discretionary, it means that the trustee, the person or persons who are managing the trust, have the discretion over if, when, and how to pay assets to beneficiaries. So the trustee might decide, okay, I'm going to pay this much from the trust this month because we know that the beneficiary has X amount of expenses this month. So we have the discretion to pay a little bit more or pay a little bit less or not pay anything this month. That's discretion. Trustee has authority and discretion over whether or not to pay. A non-discretionary trust is a trust that has some very specific instructions that the trustee must follow. You must pay $10,000, a month over the next 12 months, for example. It's non-discretionary, right? So very specific instructions to follow. Right? So family trust can be discretionary or non-discretionary. They can achieve multiple objectives, including the minimization of probate fees, if set up while living, if that's inter vivos, controlled distributions to beneficiaries, protection from creditors, or division on relationship breakdown. We talked about some of those potential benefits, and minimize delays or confidentiality in the case of an inter vivos trust. Next slide, please. Okay, so let's take a look at an example. Here we have Kelly and Fred, both age 60. They've got one child, Sam. Sam is married, has two kids, Michelle 10 and Colin 8. Kelly and Fred want to set aside money for their grandkids, Michelle and Colin, post-secondary schooling and an eventual inheritance of $400,000. Sam is to manage the gift. So Sam is Kelly and Fred's son. He's to manage the gift. So he's to be the trustee, and the money is to be used for the kids' benefits, right? The grandkids' benefit. Kelly and Fred decide to establish an inter vivos family trust. It could be testamentary, but in this case, they've decided to establish a trust before they die, an inter vivos trust. Next slide, please. So working with their lawyer, they create an inter vivos trust. I mentioned that with testamentary trusts, you typically establish those by way of your will. You go to your lawyer, you say, I want to put a trust provision in my will so that when I die, it creates a testamentary trust. That's how testamentary trusts are typically established, via a provision in a will. And then, of course, the estate settling the asset, transferring the assets to the trust. With an inter vivos trust, what typically happens is you go to your lawyer, because it's a trust established while you're living. You go to your lawyer and you say, hey, look, I'd like to create trust terms. Right? Create a document that's going to define the terms and conditions for this trust. And the lawyer will work with you and create that document. And then you can, whatever asset is you wish to settle on the trust or transfer to the trust, you do that while you're living. Right? So in this case, working with the lawyer, they create an inter vivos trust with the following terms. Sam, which is the son, is to be trustee. Right? And you can also name alternative trustees. Perhaps you want to name corporate trustees if you can't think of anybody who's an appropriate trustee. But in this case, they name Sam the trustee. Michelle and Colin, the grandkids, are the beneficiaries. And there's some specific instructions that Sam is to pay $20,000 per year to each child for each year they attend college or university. And then at age 25, each child is to receive $50K. At age 30, each child is to receive 50% of the trust balance, right? So you can see what they're doing is they're leaving instructions to pay out this money over time, as opposed to just saying, here's a lump sum of money, give it to the kids, right? So the trust is allowing you to manage those assets. Alternate beneficiaries can be named if Michelle and or Colin died before receiving their inheritance. Next slide, please. And what have they achieved here? So because it's an intervivals trust, because the trust was established while they're living, the money transferred to that trust will not flow through their estate. If it doesn't flow through their estate, then you avoid the probate fees on that asset that was transferred to the trust before death. In this case, roughly $6,000 in tax savings, right? If that money's not subject to probate. We're able to manage the distribution of those assets over time. We're able to achieve protection from creditors, and we're able to avoid delays in settling the estate. All right? So again, this was the objective of Kelly and Fred. We think they've achieved their objective using a family trust. Next slide, please. So points to remember with family trusts, particularly if we're talking about family trusts set up while we're living. Appreciated securities transferred to the trust would normally trigger taxable capital gains. Remember I said earlier, when transferring appreciated assets to the trust, you're accelerating your tax bill, right? So that's what would happen here if we're transferring securities that have gone up in value. If the settlor is also trustee and beneficiary, I don't want to get too technical here, but if the person who's settling the trust continues to manage a trust, so they are a trustee or they're a beneficiary of their own trust, then there's some special attribution rules that could apply that can result in any future income and gains being taxed back to that settlor as opposed to being taxed to the trust or the beneficiaries. There's a special rule in the Tax Act that ensures that you're not using the trust as a sham just to move around taxation. So that's what that point recognizes there, right? There's legal fees to set up the trust and tax filing fees each year. The trust is its own separate entity. So to the extent that the trust generates, taxable capital gains or realizes income to be paid to beneficiaries, then it typically has to file its own tax return. So there can be legal fees and fees to file the returns each year. And if discretionary, must be confident that the trustee will manage the assets in the best interest of all beneficiaries, right? So if you're saying to the you're saying to the trustee, this is going to be a discretionary trust, you're saying that the trustee will have the authority to pay if and when they deem fit. So you have to be confident that they're going to manage things in the best interest of all beneficiaries. Or perhaps this is where you have multiple trustees, right? To keep everybody accountable. That's possible as well. Okay, next point, next slide. So that's the family trust. I want to take an opportunity now and talk about spousal trust. Some of you may have heard of spousal trust before. What is a spousal trust? A spousal trust is established for lifetime support of a spouse or common law partner. It can be established before death or established at the time of death. I'm not going to go through each of these points here. You can read them on your own, but safe to say, what you want to do with a spousal trust is you want to leave an asset or assets specifically for a spouse or common law partner when, again, you can set it up while you're living. A lot of times we see it set up at the time of death, but you want to leave this asset for your spouse or common law partner, but upon your spouse or common law partner's passing, you would like to see those assets distributed to beneficiaries of your choice, as opposed to the choice of the spouse or common law partner. Now, where might that make sense? That might make sense in blended relationship scenarios. Next slide, please. And I'm going to give you an example of what I mean. Next slide, please. So here we have Scotty. And Scotty's got two kids, Sandra and Kyle. Scotty also owns a cottage. And that cottage has been in his family for generations, handed down from generation to generation. And Scotty would very much like to see that cottage flow to his kids at the appropriate time. Now, next slide, click, please. recently, Scotty met Jane, and Jane has a child, Alex, from a previous relationship. Before long, a relationship ensues between Scotty and Jane. Click, please. And Scotty's doing some planning, and Scotty says, hey, look, love Jane, love her so very much, want to provide for her. Something happens to me, I want to provide for her the rest of her lifetime. But upon her passing, I'd love for that cottage, click please, I'd love for that cottage to flow back to Sandra and Kyle, right? So is there a way to do that? Yeah, for sure there's a way. Click please, next slide. You can use a spousal trust to achieve this, right? Scotty can request the setup of a spousal trust. We typically see these things done at death, so a testamentary trust. And because Scotty is leaving the asset solely for his spouse while his spouse is still living, it's entitled to a tax-free rollover. So there's no tax when the cottage flows into the spousal trust for Jane. So Jane can be a lifetime beneficiary here, right? Jane can have full access to the property of the spousal trust. Jane will be entitled to any income from the spousal trust, can use the capital, right? But upon her passing, as per the instructions in the trust document, the trust will be wound up, the assets would be transferred to Sandra and Kyle, right? And away you go. So you can see that spousal trust can play a role, can help to achieve objectives. In this case, it was providing for blended family scenarios. Okay, next slide, please. All right. Let's move on and talk a little bit about trust for disability planning. Yeah. If I've got a child or children who are living with disabilities and can't appropriately manage money, then I may want to put a plan in place to ensure that they're going to be provided for after I'm gone. But at the same time, I may not want to give them that money directly because, like I said, they can't manage money appropriately. Or number two, they might be receiving government benefits in respect of their disability, government benefits that would be clawed back or reduced if they receive significant assets or income from another source. In Ontario, many individuals are receiving ODSP, Ontario Disability Support Payments, in respect of their disability. Now, ODSP is income and asset sensitive. So the more income you receive and the more assets that you have, the government actually claws back your access to the ODSP benefit. So a trust can help here now. When you set up a trust, beneficiaries can benefit while a trustee exercises control over income and capital. If the trust is discretionary, it's often not considered an asset for social assistance purposes. So we often refer to this type of trust as a Henson trust. And the term Henson is comes from the name of a family who was the first to create such a trust. Next slide, please. And I want to take an opportunity and describe this scenario here for a minute. Click, please. Here, Ross was born in Guelph, Ontario in the 1980s. Leonard Henson, a widower and Guelph resident, had a daughter with a disability. Her name was Audrey. Now, Leonard knew that if he left the estate to Audrey directly, social assistance benefits would be lost. Leonard tried to find a way around this, and he decided on an absolute discretionary trust created by his will. So Leonard updated his will to include the trust terms. So he created this, he wanted this testamentary trust to be created at the time of his death. He wanted these assets to flow into this testamentary trust, but he wanted it to be a trust such that it was absolute discretionary trust, an absolute discretionary trust. In other words, the trustee was to have full control over that money. The beneficiary would not be able to force any payments from the trust. Therefore, if the beneficiary can't force any payments from the trust, then one cannot say that the beneficiary owns the assets in that trust, which means one cannot say then that the assets and income of the trust belong to the beneficiary, resulting in a clawback of benefits. That was the thought. Okay, next slide, please. So what happened here is on Leonard's death, Leonard's will created the trust as per his wishes. They settled the trust. The trustee was the Guelph Association for Community Living. The beneficiary of the trust was Audrey. And then on Audrey's death, the trust funds were to be distributed to the Guelph Association for Community Living. Now, the ODSP office determined that Audrey inherited her father's estate and they clawed back or terminated her benefits. The trustee of the trust, the Association for Community Living, challenged the decision, and the case ended up in court. After a decision and a failed appeal, pension trusts were deemed to be effective in preserving social assistance benefits, at least in Ontario, and that's when the Henson Trust concept was born. All right? So that's certainly something to keep in mind. We see it get referenced or referred to quite often in disability planning, and it works because what you're establishing is you're establishing this trust that is a discretionary trust. The trustee has full control over if, when, and how to pay out the assets to beneficiaries. And because that's the case, one cannot say that the assets definitively belong to the beneficiary, which causes a problem for the social assistance office, if they're looking to claw back assets. Next slide, please. All right, so what does this mean for planning? Let's click through here. Pension trusts can ensure that assets are managed for beneficiary over time, prevent loss of social assistance benefits. The trust should be fully discretionary. It can avoid intervention of the public trustee. If I leave assets directly to a beneficiary who is living with a disability and can't manage money, then the public trustee would likely have to step in and guard those assets for that beneficiary. You can avoid that with a Henson Trust. And you can control the distributions after the beneficiary's death, so you can redirect those assets to other sources. Graduated tax rates are available if the trust if the trust is a testamentary trust or a qualified disability trust. What does that mean? I mentioned earlier that from a tax perspective, and we'll talk more about tax towards the end of the presentation, but I mentioned earlier that trusts are not typically used for tax reasons, and some of the tax benefits associated with trusts were eliminated by the government in recent years. Now, there are some exceptions to that rule, and one of the exceptions is a graduated estate, GRE, graduated rate estate, and one of the other exceptions is a qualified disability trust. They have graduated tax brackets and rates. So just like individuals, as income increases, your tax rate increases. That applies for qualified disability trusts and graduated rate estates, whereas other trusts are subject to tax at the top tax rate. We'll talk more about that later. Next slide, please. All right, so that's Henson Trust. Let's talk a little bit about alter ego and joint partner trusts. That's another term that gets used from time to time. It's another term that defines a certain type of trust, but it's really for a trust for individuals who are 65 or older, right? So what is an alter ego or a joint partner trust? Inter vivos trust, so trust set up while you're living for yourself, is referred to as an alter ego trust. Or if it's for yourself and a spouse and common law partner, it's referred to as a joint partner trust. Now, with an alter ego trust, the settlor, or with a joint partner trust, the settlor and a common law partner must be entitled to receive all income of the trust each year, and no one other than the settlor or a settlor and a spouse or common law partner can use the capital until the death of those individuals. In other words, with an alter ego trust or a joint partner trust, nobody can be entitled to any income or capital of that trust other than the person who settled that trust and the spouse or common law partner in the case of a joint partner trust. Okay? Now, the person settling the trust must be 65 or older. So individuals younger than 65 would not be looking to establish an alter ego or joint partner trust. But one of the main benefits of an alter ego or joint partner trust is, like a spousal trust, you can transfer assets into the trust without triggering tax. Right? So you can transfer stocks and bonds and mutual funds, and in some cases, principal residence, property, real property, into the trust without triggering tax. Taxation occurs on death of the settlor, or on death of the settlor or spouse, common law partner, whoever is the last to die. Next slide, please. Now, alter ego and joint partner trusts are often used for probate planning, because you're setting it up before you die. So it avoids the estate. If it avoids the estate, the asset avoids the estate, it reduces your probate fees, right? It can be used for creditor protection. It can be used to control assets beyond death. It can be used to avoid estate settlement delays, should there be delays in settling an estate, because it bypasses the estate. It can be used as a will substitute. Some people just say, hey, I'm going to create this trust. I still think you should have a will, but some will create this trust and flow the assets through the trust. And because there's specific terms and conditions for this trust, then they can kind of use that as a will substitute if that's their wish, right? But next slide, please. If we take a look at an example of how one might use it, here we have Victor. Victor's a widower, age 70, 3 adult kids, Steve, Kim, and Sean, and also has a grandchild, Jasmine, at age 15. Steve is one of the kids. Steve is single. Kim and Sean are married, but Steve has struggled with drug addictions recently and is a spendthrift. Jasmine will attend university soon. So Victor has $2 million earmarked for his kids, for their inheritance, and he's thinking about options for the transfer of those assets. His goals are to protect the assets. Remember, we said Steve has struggled with drug addictions and, doesn't manage money appropriately. So we want to protect the asset, and we also want to minimize fees where we can. Next slide, please. So what Victor can do is he can transfer the $2 million into an alter ego trust for himself. And there's no tax there because it's an alter ego trust. He can transfer it in without triggering a taxable event. He can be the trustee of his trust, right? Because he may still want to dip into it. He still might want to use it, that money, right? Like he wants a scenario where he can still control this money, use this money, but yet, achieve some probate savings via the use of a trust and spell out some specific instructions for the assets on a go-forward basis. So he can transfer the asset into the trust on a tax-deferred basis. Capital gains taxes would be paid upon his death, and then the assets can be paid out to the beneficiaries at that time, or can be held as part of a trust going forward, which would no longer be an alter ego trust because he's passed on, right? But the main benefit of an alter ego trust is the transfer of the assets into the trust without triggering tax. So you can get the benefit of the trust, provided Victor's the only one that can use the income or capital of that trust while he's still living. Okay, next slide. All right, so what have we achieved here? Avoidance of probate fees, in this case, about $29,000 in tax savings in probate because the asset avoids the estate, controlled distributions at death, immediate access post-death, and protection from division in relationship breakdowns, that type of thing. Okay, next slide. Be mindful of future income and gain. So again, Victor transfers this asset to the trust. It's a trust for his benefit until he dies. Because he's also the trustee of his own trust, because he's also a beneficiary of his own trust, any future income or gains are taxed to him until he dies, right? So in effect, the government just kind of looks through the trust and assumes he's holding the asset solely for himself, but yet he gets the benefit of, avoiding probate and avoiding complex estate settlement and so on and so forth, right? But the taxation still comes to him until he dies. He can name an alternate trustee should he wish, and instructions of death should be clear. After his death, he must be confident that future trustees will manage the assets in the best interest for all beneficiaries. And of course, there could be legal fees to set up the trust and tax filing fees each year. Next slide, please. All right. So that's the alter ego trust. Now, What about in trust for accounts? I'm not going to spend a lot of time talking about this, but what I'm referring to here is sometimes some investors who have minor children or grandchildren might go to the financial institution and say, look, I want to give some money to my minor child or grandchild, but they can't set up an account for themselves because they're minors. What can we do? And the financial professional might say, well, you can set up an in trust for account for the minor, right? It's an account where they're the beneficiary and somebody else can manage the asset for them because they are minors. There's debate around whether or not an in trust for account, which is often referred to as an informal trust, is in fact a trust. There's some debate around that, okay? And I'm not here to answer that question because some might say it is, some might say it isn't, not clearly defined yet, right? But the point that I want to make on this slide is when we refer to trust and everything I've set up to this point, prior to this slide, I'm referring to a formal trust, right? A separate entity that you're establishing that is its own entity to hold assets on behalf of beneficiaries. With an in trust for account for minors at the financial institution level, that's not typically the case. You typically don't have this formal trust relationship that files its own tax returns. You typically don't have that within trust for accounts. So there are formal trusts, your alter ego, your Henson trust, your spousal trust, your family trust. Those are formal trusts. And then you have informal trusts, which are these trusts that are typically set up for minors, right? So I just wanted to draw the distinction between the two types of trusts. Next slide, please. So let's talk about the taxation of formal trusts. Next slide. How are these things taxed? The Tax Act treats these formal trusts as separate entities. It's its own taxpayer, essentially. Okay, and any income or gains that are realized by the trust are normally taxed to the trust at the top tax rate. That's normally the case. But it is also possible that if the trust earns income or if the trust earns capital gains, the trustee can actually arrange for that income or capital gains to be paid to the beneficiaries in the year that it's earned. And if it's paid out of the trust to the beneficiaries in the year that it's earned, it can be taxed in the hands of the beneficiaries as opposed to the trust. Okay, so while trusts are normally subject to tax at the top tax rate, to the extent that there's realized gains or income, those realized gains or income can be paid out to the beneficiary and taxed in their hands, right? Trust income, as mentioned, subject to tax at the top tax rates. We can get around that. And there's a 21-year deemed disposition rule. And some might be wondering, well, what is this 21-year deemed disposition rule that I've heard of? Well, it's a rule that's in place that says, look, if I buy mutual funds and put it in a trust and I just leave them there and I don't switch them, I don't trigger any tax on them, I just let them sit. Then in theory, if I never did anything with those funds, they'll grow and grow and grow and grow and grow and grow and grow, and the government may not see taxes forever. So what the government has done is they said that certain trusts are automatically deemed to sell those assets every 21 years. So it's forcing taxation from those assets every 21 years. So there isn't this indefinite period of tax deferral, right? That's what the 21-year deemed disposition rule does. In practice, what we often see as assets approach the 21-year deemed disposition rule, what we often see is trustees transferring the asset out to the trust beneficiaries at cost without triggering tax at that time, and then allowing the beneficiaries to trigger tax on that asset when they deem fit, right? So there is a 21-year deemed disposition rule, but there is some planning that could be done to avoid that. Next slide, please. All right. As mentioned, there's typically taxation on transfer to the trust. There are some exceptions to the rule. Spousal trust is the exception. Alter ego and joint partner trusts are the exceptions. Where those trusts are available, you can transfer assets to those trusts without triggering tax. Next point. But be mindful of attribution rules that prevent income splitting with spouse, common law partners, and minors. In other words, what I'm saying here is, if I earn X amount of income, I have a certain amount of assets and I generate X amount of income, that income's taxed in my hands. On the other hand, if I have X amount of assets and I give my spouse half of those assets, I say, you go ahead and invest those assets and earn income and capital gains. In an ideal world, the future income and capital gains would be taxed to my spouse, who might be taxed at a lower tax rate. But that's not how the rules work. If I give my spouse or common law partner a certain amount of assets and my spouse, common law partner invests those assets and earns income or cap gains, the income or cap gains get taxed back to me under an attribution rule. Right? Because the government says I'm just gaming the system, right? I'm just doing this just to reduce taxation for the family. The point I want to make with this slide here is, if I give my spouse or my minor children assets by way of a trust, does that allow me to avoid the attribution rule? And the answer is no, it does not, right? The use of a trust does not avoid the attribution rule. So if I leave assets in a trust for my spouse while I'm still living, and my spouse realizes income or capital gains, or my child realizes income, then there's still attribution of that to me, even though I use the trust, right? So you wouldn't use a trust, again, to try to achieve significant tax benefits from the trust, because there are attribution rules and other rules that are designed to prevent that type of gaming. Okay, next point. And there's another attribution rule as well that can result in all income and capital gains being taxed to the settlor. That normally presents itself where I am settling the trust, I'm putting assets into the trust, but I'm going to continue to control those assets going forward, and I might even be a beneficiary, like the alter ego trust. In that case, everything gets taxed back to me under the Tax Act. Okay, next point. Tax returns are required for your trust, typically within 90 days of year end. Next point, please. All right. Now, before I wind up and we go to Q&A period, I want to take one opportunity and talk a little bit about new trust reporting rules, because you can't talk about trusts and not talk about new trust reporting rules. Trusts have always been subject to tax as long as I can remember anyway. Trusts have always had to file tax returns as long as I can remember anyways. Formal trusts I'm talking about. But in recent years, the government has indicated that they are looking for more disclosure regarding trusts. The concern here is that the government believes that there are individuals who have trusts and they're not sufficiently reporting their income or capital gains from those trusts. And the government wants more information on these trusts so that they can track these trusts over time, right? So in a recent federal budget, can't remember if it was 2023 or 2022, could have been both years even, the government indicated that they were going to introduce new rules to require new reporting for trusts. The government wants additional disclosure about trusts. They want more information about the settlor of the trust, the trustees of the trust, the beneficiaries of the trust, any person that can exert influence over the trust. Not only do they want their name, their address, their date of birth, their jurisdiction of residence. They want their taxpayer identification number, such as a SIN, business number, trust account number. They want more information, you can see, with limited exceptions. And there would be penalties for incomplete or inaccurate information. And this trust reporting started for trusts that had a December 31st, 2023 tax year end. So for the 2023 year and the 2024 year and going forward. Now, there was a lot of concern around these new rules. And the concern wasn't so much that trusts that would ordinarily need to file have to provide more information. Yes, that's inconvenient. Yes, that can add to compliance costs. But the truth is, given that most formal trusts, depending on its activity, would have to file a tax return anyway, the thought was that this additional information, while inconvenient, was still doable. What raised a lot of concern in the industry and frustrated many in the industry is that the government indicated that bare trusts would be included in these rules. Well, what is a bare trust? Well, a bare trust is a scenario where one person acts as the agent for another. So in other words, I own a particular asset. I'm the beneficial owner of that asset, but perhaps I don't want people to know that I own it for any number of reasons, right? Perhaps I want to maintain confidentiality. Perhaps I'm working in a job that requires me to have a certain level of confidentiality. So what I can do is I can have somebody else act as my agent. And somebody else's name will go on title of that property, but I would continue to be the beneficial owner. I would continue to call all the shots. That person's name's on title only for a matter of convenience and confidentiality and so on and so forth. That is what, in simple terms, a bare trust is. One acting on behalf of the other, but the other continues to be the beneficial owner. So the concern here is there are certain arrangements out there that one might consider to be a bare trust. If I'm listed as a joint owner on my mom's investment account, but my mom continues to be the beneficial owner, it's her account, she's calling all the shots, I'm only on it as a matter of convenience, one might suggest that that is a bare trust arrangement. If I set up an informal account for a minor child at a bank or other financial institution, the money vests in that beneficiary, that minor, right away, but I, as a trustee and managing it on their behalf, some might suggest that that is a bare trust arrangement. And the government originally indicated that bare trusts would be required to provide this additional disclosure into additional information, as well as other formal trusts. And this concerned a lot of people because think about the number of joint accounts there are out there. Think about the number of informal in trust for accounts there are for minors out there. Would they all be required to provide name, address, date of birth, jurisdiction of residence, taxpayer identification number, and so on and so forth for all these accounts? So it created a stir in the industry, and ultimately the CRA decided via the Department of Finance, via the CRA, I should say, decided to exempt bare trust from this additional reporting for the 2023 year and the 2024 year. All right. So the new disclosure may still be required for formal trusts, but for other formal trusts, I should say, but for bare trusts, they're exempt for 2023, 2024. We'll see what happens for 2025 and going forward. All right. So I just wanted to bring that to your attention. I'm sure that Per, Erik, and Jeff can talk with you more about that if needed. But I could not have a trust presentation without talking about the new trust reporting rules. So I hope that's helpful to you. Next slide. That's it. I think that brings us to a close. It looks like we got about another 5 minutes or so to the hour, but that's my Trust 101 presentation. I hope it was helpful to you. If there are any questions, I'm happy to take them at this time. Any questions?
Oh, great. Well, thank you, Wilmot. Yeah, we've got a number of questions. A few questions come in ahead of time, and I'm sure some more questions may come in now.
Yeah.
To start with, so is there a reasonable amount of money that someone should have to start a trust?
Yeah, that's
and we're talking about formal trust here, not the informal in-trust account.
Yeah, that's a big question. I don't quite know how to answer that one. Right? Because if you got, $50, you're not going to set up a trust for $50, right?
Yeah, because the costs are going to eat that up. Because
the costs are going
to lawyer fees and annual filing fees, and annual filing fees are not the same as what you're used to paying when you do your personal taxes, right? So they're somewhere between a personal and a corporation return. Cost usually ends in the word thousand. So,
it's cost benefit, right? When you address that question, it's kind of a cost benefit thing, right? Because somebody might say, look, it's not $2 million, it's $100,000. But I can't put this $100,000 into the hands of my child who is a spendthrift or living with disabilities. I just can't.
Yeah.
Right? So it's not $2 million, it's 100,000 or 150. you know, so is it worth setting up a trust for 100 or 150? Some might say yes, some might say no, right? It depends, right?
Yeah.
But if I'm gonna set if it's 100 or 150 and I'm thinking I can leave this money directly to my kids, or I can set up a trust. And the only reason I want to set up the trust is just because good thing to do. Don't want to put the money in the hands of my child direct. Then maybe I don't set up the trust, right? But if my child's a spendthrift, or if my child is living with disabilities, right, then yeah, it might make sense for 100, 150, right? So, you know, how much money should you have? How much should you be putting in a trust in order to to make it worthwhile? Cost benefit. I struggle to give an answer there, because I think the answer will differ depending on the individual based on where their priorities lie, right? What they're trying to achieve, right?
Yeah, and I think one of the most important things you said the whole time is that this is not necessarily a tax saving vehicle. This is
Right,
more of a
right.
control and probate and making sure that the
Yeah,
things that you want to have happen to your money actually happen, right?
you
And
got
that's
it.
what it's really about, right?
Right.
There is some ability to do some income splitting if you set it up correctly from the start,
Yeah,
but in general, it's not a tax saving vehicle. You're still going to pay tax.
that's right. You got
Yeah.
it.
And the other thing that was kind of interesting about trust is that while the income that's earned in the trust is taxed generally at the highest marginal tax rate, unless it's in a first 3 years of a testamentary trust.
Yeah.
And so you want to be distributing out the income ideally,
We
right?
often see that. Yeah, we often
Yeah.
see that where that's possible for sure.
Now someone else asked, can you put your principal residence in the trust? Is that something that people should do?
Uh, oh man. Sometimes uh you get a simple question, but it
Yeah.
doesn't always have a simple answer.
No, none of these do. That's why you're here.
Right? I
Yeah.
understand the question. Can we put a principal residence in a trust? Well, yeah, you can put whatever you want in a trust. The question, but I think what the person who asked the question is really asking is, if I put a principal residence in a trust, can I still claim the principal residence exemption to shelter the principal residence from tax when I sell it? Right? I think by extension, I think that that's where the question
Yeah.
is going, right? So yes, you can move a residence into a trust. You can move stocks, bonds, mutual funds, investment property, vacation property, all of that stuff can go into a trust. Yes. But not all of that is going to be entitled to the principal residence exemption down the road.
Right.
The government recently changed some legislation with respect to trusts, and specifically who can claim a principal residence exemption within a trust, right? There's only certain trusts that are entitled to claim the principal residence exemption in respect to property: alter ego trust, joint partner trust, spousal trust, self-benefit trust. So there are limited opportunities to claim the principal residence exemption where that property is in a trust. All right.
Yeah.
So if the objective is to move the principal residence into the trust for the purpose of still claiming the principal residence exemption, you want to be very careful with that, because only certain trusts are entitled to the principal residence exemption. Not all trusts allow for that.
So basically what you would probably do then, if I would put it into the trust and you would recognize the principal residence exemption, then any growth from there would be taxable, I
Yes.
guess.
Yeah.
Unless you're using the alter ego trust or something like that.
You got it. You got
Yeah.
it. Unless you're using one of the trusts that allow for the principal residence exemption, and again, those are limited, then essentially moving it into the trust, you'd want to trigger a disposition on the way into the trust, use your principal residence exemption up to that point, and then any future growth in the trust would then be subject to tax going forward.
Okay. Interesting.
Mm-hmm.
Okay, so now what happens if we transfer a rental property into the trust and we're using that for short-term rentals, so Airbnb kind of thing, and this is not the one that we're have a 1 or 2 year lease with somebody.
Mm-hmm.
Do the rules, I guess the tax rules are pretty much the same, right? There's no
Yeah.
avoidance of those short-term rental tax rules, right?
You got it. You got it. I mean,
Yeah.
you transfer the property to the trust. You know, presumably you're triggering a disposition there, depending on if beneficial ownership is going to change. And as you earn your rental income on a go-forward basis, the rental income is still subject to tax. So the trust here is realizing rental income. That rental income will be subject to tax in the hands of the trust at the top tax rate. And then, you know, the trustee would have the option to pay out that income immediately to a beneficiary of the trust and tax it in their hands.
Yeah.
But the rental income would still be subject to tax, whether it's at the trust level or the beneficiary level, just depends on how it's handled.
All right. Another question that came in about capital gains. So as you know, the new capital gains rules for individuals have a capital gains inclusion at 50% up to the first $250,000 of gains, and then it becomes quite punitive thereafter under these new rules. And so that is still a benefit for individuals. So you can do some tax planning around that and recognize capital gains over time, and you get, you know, you still get that the old 50% inclusion rate. Does that apply to trusts, or does it go straight to the 2/3 inclusion in trusts?
Good question, eh? You would want everything to be simple and all the answers to be simple.
I do, yeah. I do. I want it all to be simple. You could just say, do this pair. That would be great.
The answer to your question is some trusts are eligible for the 250, others aren't.
So the alter ego ones probably are eligible, right? I would assume.
Graduated rate estates and qualified disability trusts. So to my knowledge, it's only two that are entitled to the 250 50% inclusion rate threshold, and that was a recent change. For you know, when that change was first introduced, it was all trusts were not eligible for the 250, and then they modified the rules a little bit, and now certain types of trusts are eligible for that 250, and they are graduated rate estates. Right? Because when you die, your estate effectively is a graduated rate estate for 3 years. So that's entitled to the 250, and so is qualified disability trusts. So these are disability trusts, you know, where you're entitled to the disability tax credit. Then those trusts are eligible for 250. Everything else is 67% inclusion rate.
Ouch. For testamentary trusts, are they considered graduated rate trusts, or no? Or are they straight at the top marginal rate?
Top marginal rate.
So that's no good. Okay, and then with a testamentary trust, another question someone had was, if what happens? So let's say they leave money in a testamentary trust to their son, who for whatever reason they want to leave it in a trust. Doesn't matter why. And but now the son passes away. What happens to that money? Where does it go?
Okay, good question.
Who gets the money?
Good question. This is where drafting of the trust terms are important. And this is why we often say it's a good idea to use your lawyer to draft your will, right? You can draft your own will, can't handwrite it, sign it, boom, that's a legitimate will. But when you do things like that, if you don't have certain expertise in certain areas, you can walk yourself into a trap, right? And this is one of them.
Like doing your own electrical at home. Not good either.
Right.
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 Shocking.
That's right. But if you go to your lawyer and you say to your lawyer, I want to establish a testamentary trust, your lawyer's going to say, okay, so you're the settler, you're putting money into this trust upon your death. You're going to name a trustee. Okay, great. Who is your beneficiary? Oh, my beneficiary is my son. Okay, great. Your lawyer should turn to you and say, okay, what happens if your son dies before this trust is fully paid out? And you're going to say, I didn't think about that. Maybe I should name an alternate or a backup or a contingent beneficiary, right? So lawyer says, yeah, good idea. So your beneficiary will be my child, and should my child predecease the settlement of this trust or the collapsing of this trust, then I would like the rest of the proceeds to be paid out to my daughter or my neighbor or my friend or what have you, right? So the answer to your question is it quite often resolved by how the trust terms are drafted, right? If you don't draft those trust terms appropriately, then you can walk right into the trap of the beneficiary not being around to benefit from the trust.
Yeah.
And that just adds more complexity.
Oh yeah. Well, okay, let's not do that.
Mm. Yeah.
So who, and if we're setting up a formal trust, like what people call, the family trust,
Mm.
or who is typically the settler of the trust?
Person who's transferring the assets into the trust.
Okay.
So I'm thinking, I want to set up a family trust
Yes.
because if I leave a couple 100,000 to my son, perhaps my son is 18, perhaps 19, 20, and I leave the money to them directly. Shiny red sports car shows up in the driveway the following day. And I don't want him to do that.
That's right.
So I'm going to leave him the money by way of a trust and have somebody else manage it and pay out those assets to him over time. That'll stop the shiny red sport car. So in this case, I am requesting the trust. I have the $200,000, what have you. I'm going to put that into the trust, whether I do it while I'm living or at the time of death, doesn't really matter. So I am the settler. I am creating that trust with the asset I'm transferring into the trust for the benefit of my son, who's the beneficiary, and it's going to be managed by a trustee who I name. Yeah.
Okay. Here's a good question from actually Kashfi had this question. What happens when the beneficiary wants to change the terms of the trust, but the settler is already deceased?
Can a beneficiary change the terms of a trust?
No, I guess the trustee wants to change the beneficiary's terms of the trust, but the settler is already deceased.
Yeah, you typically can't do that, right?
No. So that's it, right?
Yeah, you typically can't do that. Trustee doesn't have the authority really to change the terms of the trust. The trust may be discretionary, meaning that the trustee can pay out if and when and to whom, right, they deem fit. But they typically can't do things like change the beneficiary or that's like making testamentary decisions, right? A trustee typically can't do that type of thing.
The settler can do that. The settler can add beneficiaries if they want to.
Yeah, I'm not sure what the process is for that. You talk to your lawyer about what that process looks like. But look, if the settler settled the trust, then presumably when they settled the trust, depending on the terms and conditions that they spell out when they set up the trust, they may or may not be able to do certain things, right? But if they're the settler and they created the trust, then fine. Again, talk to your lawyer about what that process looks like. But I haven't really seen any situation where a trustee can change the terms of the trust. The trustee is hired to carry out the terms of the trust.
That's
they
right.
typically don't have the authority to change the terms of the trust.
Well, yeah, I had a lot more questions, but most of them were answered by your presentation, so that was really helpful. Thank you, Wilmot.
Good, my pleasure. My pleasure.
Yeah.
All right.
Eric, do we have any more questions?
Rita asked about the tax changes, but I did think we looked at them. I mean, particularly the capital gains inclusion rate and how that affects trust. So I don't know if there's anything else to add, but I think that was the big one. I mean, trust tax at the highest rate. Generally, there are some exceptions, as Wilmot pointed out.
Yeah.
But trust does not equal tax savings. I guess the big lesson learned from this, probate savings potentially, but remember, trust for control rather than tax savings. It is the thought, I think, is the really good one to keep in mind for everybody.
Yeah.
That's right. Let's see this. And so for everybody that's on this call or signed up for it, there will be a recording.
Yeah, we'll send that out. Leah will send that out shortly once we get the approvals. So everybody will get a copy as well. And you can listen on your own time if you wanted to double click on certain regions, because we covered a lot today. So a big thanks to Wilmot for sharing all that wisdom. And I think we got a lot out of this. So
good.
All
right, Per, do you want to wrap us up?
All right. Well, I wanted to thank Wilmot for taking the time to join us today to talk about this. Trusts are important, but like we said, they're more for control than for tax planning per se, but it is important. Also, Wilmot, I know a lot of effort goes into preparing for this, and preparing the slide deck and thinking about, what do you want to share and how to share it in an understandable manner. And one of the things I really appreciate about you is, just your ease in explaining difficult concepts and making them understandable. So I really appreciate that. And I think that's why Erik and I and Jeff, really enjoy having you share your wisdom with us. So I want to thank you for that.
Well, thank you. I appreciate you guys. Always enjoy the opportunity to share this and the questions that come in are always great too. It allows me to go back and think about those questions, and quite often, they show up in future presentations that we write and articles that we write and so on. So
wonderful.
I certainly appreciate the dialogue, and thank you guys for the opportunity to chat today. Thank you, everybody.
Thank you. So thank you to Wilmot. Thank you to our partners at CI Global Asset Management for setting this up. Thank you, Erik. Thank you, Leah, for organizing all of it and doing all the work in the background. That's a lot of work. And with that, I hope everybody has a wonderful Monday, or whatever day it is when you're watching this on YouTube.
Thank you, everyone.
Bye-bye.
All right. Bye-bye now.
Bye.